Welcome back to the Indicator Library. Today, we're covering one of the most debated tools in technical analysis, Elliott Wave Theory. Some traders believe it predicts the future. Others believe it's too subjective to use. The truth sits in the middle. In this video, we'll break down what Elliott waves actually represent, the 5-wave impulse structure, the 3-wave correction structure, core rules that cannot be broken, where traders misuse it, and how to use it realistically. Let's begin. Elliott Wave Theory is a framework for understanding crowd psychology. It suggests markets move in repeating cycles driven by emotion, optimism, excitement, fear, capitulation. It is not a precise timing tool. It is a structural framework. In a trending move, price typically unfolds in 5 waves. Waves 1, 3, and 5 move in the direction of the trend. Waves 2 and 4 are pullbacks. Wave 3 is often the strongest. This creates a stair-step pattern. Impulse, pullback, impulse, pullback, impulse. After a 5-wave impulse, markets often correct in 3 waves. This is labeled A, B, C. Wave A moves against the trend. Wave B attempts a continuation. Wave C completes the correction. This forms a 5-to-3 structure overall. There are hard rules. And when those rules break, the count is invalid. Let's separate validation from invalidation. First, validation. Wave 2 must not retrace beyond the start of Wave 1. If it does, the structure resets. Wave 3 cannot be the shortest impulse wave. It is usually the strongest. Wave 4 must not overlap Wave 1 in a standard impulse. When these rules hold, the structure remains valid. Now, invalidation. If Wave 2 breaks the origin of Wave 1, the count fails. If Wave 3 becomes the shortest, the count fails. If Wave 4 overlaps Wave 1, in a standard impulse, the count fails. This is not subjective. These are structural boundaries. When structure breaks, bias must adjust. Respect invalidation. Structure determines validity. If these rules break, the count is invalid. The challenge with Elliott waves is labeling. 2 traders may count waves differently. Lower timeframes create noise. That's where many traders overfit the structure. Elliott wave is a map, not a crystal ball. Experienced traders use Elliott wave to identify likely trend continuation phases, spot potential exhaustion into Wave 5, anticipate corrective structures. It works best when combined with Fibonacci retracement, momentum divergence, volume confirmation. Common errors with Elliott waves include forcing counts onto messy markets, relabeling waves after every candle, ignoring invalidation rules, treating it as a prediction engine, structure first, wave labeling second. Elliott wave works best in clean trending environments, strong impulse legs, clear corrections. It performs poorly in tight consolidation. Trend clarity improves wave clarity. Wave counts can fail. Invalidation levels matter. Stops should sit beyond structural breakpoints. Never risk based solely on a wave count. Confirmation improves probability. Hi, I'm Indy. So let's summarize. So, what is Elliott wave really? It's not a guaranteed forecast. It's not exact timing. It's a structural framework based on crowd psychology cycles. Used correctly, it helps map trend phases. Used blindly, it creates confusion. The lesson is simple. Respect structure. Confirm with evidence. Trade with discipline. If this helped clarify things for you, make sure you like and subscribe, and explore the rest of the Indicator Library. We're building real understanding here, step by step, and I'll see you in the next one.